If you start with $100 and your first impulse is, how fast can I? 10 times this. The market has already won. It doesn't reward speed. It rewards structure. The people who survive aren't the loudest. They're the ones who can repeat a boring, high-quality decision thousands of times without flinching. Tonight, we're not chasing fireworks. We're building a furnace steady heat that compounds. I'll show you how to turn a tiny account into a training ground, not a slot machine, and why the only accelerant that lasts is discipline wrapped in simple math. 4 mental pillars hold it up, but before we build, let's puncture the biggest myth. Social feeds serve a diet of miracle screenshots. $500 to $5. 0 inches a week, 3 trades, 1 emoji caption. What the frame hides is the pile of blown accounts just outside the crop. Survivorship bias edits out the bad endings. Variance dresses up as skill. Luck gets rebranded as a strategy. The story is seductive. Go bigger. Press harder. Double or nothing. But trading is not a movie montage. It's a business with inventory cash, overhead drawdowns, and a slim edge that only appears across series, not single events. If your plan depends on speed, you will eventually have to choose between breaking your rules and breaking your account. Most choose the account. So how should we measure progress instead? Think in decades, not days. A $100 account is a seed, not a scoreboard. Treat every setup as a hypothesis, not a prophecy. Risk small enough to stay calm. Journal until patterns become obvious. Measure good behavior, not just good outcomes. Did I size correctly? Did I wait for my signal? Did I exit when the thesis died? That's the compounding mindset. Protect first. Grow second. Repeat forever. When you stop trying to be fast, you get durable. When you get durable, time becomes your partner. With that lens, here's the roadmap we'll build tonight. In part 2, we'll preview 4 pillars and show, through a quick story, how calm process beats a loud gamble, even when both start with the same $100. Here's the roadmap. We'll build from 4 mental pillars that turn a tiny account into a durable engine. First, compounding mindset, growing slow on purpose. You define risk before you dream about reward. You size so a single loss can't knock you off center. And you let small, repeatable edges stack until they become momentum. Second, ruthless patience, waiting like a lion in tall grass. You don't chase, you stalk. No setup, no trade. Boredom is not a problem to solve with action. It's a signal that your discipline is working. Third, emotional detachment, treating every trade as a business decision, not a referendum on your worth. You size positions so your brain can think while your money is at work, and you accept losses as operating costs, not personal failures. Fourth, relentless adaptation, keeping the process, flexing the parameters. Markets morph. Volatility breathes. Your life changes. You adjust timeframes, risk, and tactics without abandoning your core rules. Now a quick story. 2 traders. Same day, same $100. Trader A starts with a highlight reel in his head. He risks 30% on a can't-miss breakout, scores once, and feels invincible. He nudges size up, tightens stops out of fear, and by Friday, a sharp reversal wipes out 3 wins in 2 punches. Tilted, he breaks his rules, just this once, doubles down, and finishes with $19 and a racing pulse. His conclusion: I need more capital. Trader B opens the same account with a checklist, not a fantasy. Max risk per idea e 2%. He journals context, level, trigger, invalidation, exit. He skips 3 mediocre lookalikes that social media loves. logs them anyway, and notes they would have stopped out. On Thursday, he takes one clean setup at 1-2. Woo. On Friday, a controlled scratch. He ends the week up a few percent and, crucially, calm, with notes worth more than the dollars. The difference isn't luck, it's architecture. Over this series, you'll get a practical playbook to risk less while thinking clearer, wait longer without FOMO, feel less while executing better, and adapt faster without losing yourself. Next up, Pillar 1 compounding mindset, where protect first, grow second. Repeat becomes sizing rules, a simple compounding model, and a daily checklist you can use tomorrow morning. A $100 account isn't a scoreboard, it's a seed. Seeds don't prove themselves by growing overnight. They prove themselves by surviving season's heat, cold, drought, and still pushing upward. When you treat $100 like a garden plot, your priorities flip. You stop asking, how fast can I multiply this, and start asking, how reliably can I repeat sound decisions without damaging the soil? Capital becomes soil quality. Rules become fences. Patience becomes sunlight. Compounding is not a magic trick. It's arithmetic plus endurance. A small, repeatable edge applied many times beats a big, erratic win that can't be repeated. Think in cycles, not single trades. A modest percentage gain, repeated across dozens of cycles, snowballs slowly at first. Then surprisingly, the crucial word is repeated. You're building a machine that can survive ordinary losses and keep operating. That requires keeping risks small enough that one or two setbacks don't force you to change your plan or your identity. This is why we define success by behavior, not headlines. The goal on any given day is not to make X dollars. It's to execute a clean hypothesis with discipline, not impulse. Identify context, wait for your trigger, size within your limit, and accept invalidation without argument. Over a series, good behavior converts into good math. Even a fair win rate with decent reward to risk can produce meaningful growth if the losing days don't spiral into self-inflicted damage. In that sense, protection isn't a brake on performance, it's the lubricant that keeps the engine from seizing. Thinking in decades shrinks the emotional noise of any single outcome. You're no longer auditioning for a miracle, you're showing up for practice. You water the seed, you keep the fence mended, you record what the weather did. Let time carry the heavy load. Compounding happens when you survive long enough for your small edges to stack. Protect first. Grow second. Repeat season after season. Before you dream about reward, build the walls. Risk architecture is the fence that keeps a healthy idea from getting eaten by one bad day. Start with position size. Pick a fixed risk per trade, typically 1-2% of your account, and define it in dollars before you even look at the chart. That number is your insurance premium and your protection against emotional impulse. Designed for losing streaks, because they are inevitable. If you risk it, 5% per idea, a run of 6-8 losses is annoying, not existential. Your account and your confidence remain functional. That margin for error is the difference between a temporary dip and a spiral. Add a kill switch, a max daily or weekly drawdown that ends your session automatically, protecting both your equity and your mental state. Codify before, during, after rules. Before define context, entry trigger, invalidation, and exit logic. During manage from rules, not fear. Don't widen stops to avoid pain or micromanage winners out of potential. After journal the setup, snapshot, emotions, and one lesson. Protection first does not slow you down. It keeps the engine running, so compounding can occur over time. Compounding doesn't come from brilliant moments. It comes from a boring routine that removes room for creative mistakes. Build a 5-point checklist and run it before every trade context. Level, trigger, invalidation, and exit plan. If any box stays blank, you don't trade. The checklist turns vague hope into a testable hypothesis and makes your later review meaningful. During the trade, manage from rules, not vibes. Size small enough that your prefrontal cortex remains online. If your heart rate dictates decisions, your size is too big, use if, then rules. If price tags invalidation, then exit without comment. If pashelet it then move, stop to break even. Pre-write these rules where you can see them. Respond consistently, not predict perfectly. After the trade, journal like a scientist, not a novelist. Keep it short and structured. Screenshot, checklist items, entry, exit, size, result in R, and one actionable observation. Tag emotions briefly: impatient, hesitant, greedy. The journal reveals patterns. Boredom trades underperform, while higher timeframe aligned trades show less stress and better follow-through. Data shrinks superstition, guiding better behavior. As your process stabilizes, scale lightly. Require a streak of 20-30 trades executed properly with acceptable drawdown before nudging risk from 0% to 1%. If performance worsens, scale back automatically. Growth is earned through evidence, not feelings. Finally, honor productive boredom. Uneventful sessions with no trades are not wasted. They strengthen discipline. Your edge is the routine. Compounding dies less from bad ideas than from preventable behaviors. The first thief is FOMO. It appears as urgency and whispers. This is the one. Counter with a binary gate. No setup, no trade. Define an A setup in writing context. Level, trigger, invalidation. If any element is missing, the gate stays closed. Add a trade quota to block boredom trades. The second thief is revenge trading, the emotional sequel to a loss. Install a cool-off rule. After any loss is greater than or equal to 1R, step away for 15-30 minutes. After 2 losses, end the session. Place a note on your screen. The market is not a person. You're not settling a score, you're running a system. This prevents frustration from compounding losses into spirals. Third, comparison erodes judgment. Other people's P&L is entertainment, not research. Build media discipline. No social feeds during trading hours. Only a post-market window for curated learning. Track psychological drawdown in your journal by rating stress from 1-10. If stress trends high, reduce size until it normalizes. This habit protects clarity and prevents outside noise from steering execution. Fourth, strategy hopping kills compounding's required sample size. Keep the core process fixed. Checklist, risk, review cadence, and adjust only parameters like timeframe or entry filter. Batch changes one variable per week, so results can be attributed. If performance worsens, revert quickly. This preserves discipline while allowing iteration. Guard against micro-rule bending by codifying unbreakable redline rules. Micro-rule bending includes widening a stop just this once, chasing a candle that looks strong, or moving targets to lock profits. Codify non-negotiable rules that cannot be overridden intraday. If one breaks, end the session. The point isn't perfection but prevention. Protect the seed, your capital, psychology, and process. When seeds are protected, harvests follow inevitably. Patience in trading isn't passive or timid. It's active restraint with a purpose. Think of a lion crouched in tall grass, motionless, but not idle. Energy is conserved. Attention is heightened, and the strike is reserved for a specific pattern, distance, angle, wind, timing. In markets, doing nothing becomes a deliberate position, preserving risk and capital for A setups with clarity and precision. The common mistake is to equate activity with progress. Clicks feel productive. Silence feels like stagnation. Real productivity is the number of decisions that meet your process standard, not how many orders you place. Every subpar trade you take today steals from a superior trade tomorrow. Patience converts opportunity cost into an edge by keeping you free for higher quality signals. Reframe waiting as a trade with three components: entry, risk, and thesis. Entry. You enter the waiting state when any checklist box is blank, context unclear, level sloppy, Träger missing, invalidation vague. Risk zero exposure, which protects drawdown and psychology. Thesis no setup. No trade is not a slogan, but a falsifiable statement until X and Y appear. Action is unjustified. You'll know you're practicing ruthless patience when you can watch price move without chasing. Your job isn't to catch all movement, it's to capture your repeatable patterns with controlled risk. That often means letting impressive but invalid moves pass. It stings for a moment but pays for years. Discipline is measured by resisting temptation, not chasing every flicker of price. Measure this discipline, explicitly track valid setups seen, valid setups taken, and invalid impulses declined. If the last grows, your edge matures. Patience isn't the absence of action, it's the presence of standards enforced in real time. Each declined impulse preserves energy and capital, proving restraint is performance. This transforms patience from vague advice into a quantifiable, compounding skill. Patience becomes durable. Once good enough, stops being a vibe and starts being a checklist. Grade every idea A if all 5 conditions align: context, level, trigger, invalidation, risk divided by reward. Miss 1, and it's a B. Miss 2, a C. You don't trade Bs by default, and never Cs. Standards create breathing room for patience, protecting capital from mediocre setups. Engineer the wait so boredom doesn't break it. Use alerts instead of constant staring. Define sessions you trade and avoid, maybe skip first 30 minutes or trade only. London, New York, overlap. Wrap major news in buffer zones. Volatility turns edges into gambles. Demand extra confirmation break. Retest. Decisive candle, ensuring you respond to evidence, not impulse. Boredom becomes structured patience. Write if, then statements where you can see them. If trigger fires at level with context intact and 1-2 is possible, then place the order. If invalidation hits, then exit without hesitation. Keep a 1-page card grading rules. Forbidden actions, like no chasing or no new trade within 10 minutes of a stop out. This makes waiting binary, transforming absence into a position. The market's most persuasive lie is that movement you didn't catch was money you lost. That's the seed of FOMO, and it grows into late entries, widened stops, revenge clicks. Reframe it. A move you didn't qualify for isn't your trade. It belongs to someone else's system with different risk. Your job is to harvest only the moves your process was designed to catch. When you miss a clean opportunity, resist the urge to make it back. Treat the miss like a trade you took. Screenshot it. Note which criteria were absent and write a corrective line next time. If X and Y align at Z, enter. If not, observe. This converts regret into protocol. You're not punishing yourself. You're codifying conditions that guide future action. Assume that for every one high-quality setup, 3 pretenders will appear. That ratio keeps you skeptical when charts look enticing. Set a session quota, 2 or 3 eligible ideas maximum, and let the rest pass. Quotas transform patience into a rule rather than a feeling, preventing boredom from disguising itself as opportunity. This protects consistency and shields your capital from impulsive decisions. Track psychological drawdown alongside P&L. Rate stress 110 each session. If the score trends high, reduce position size until calm returns. Calm is not luxury, it's part of edge. After near misses, close the platform and write 3 short lines what was missing, what to wait for tomorrow, and when not to act. This teaches your nervous system that no trade can be success. Patience isn't a mood but a ritual. Begin pre-session, curate a watch list. Mark key levels. Pre-write if, then rules. Script only the scenarios where you act. Everything else is noise. After each trade, enforce a visible cooldown, 5 to 10 minutes without input. Cooldowns convert adrenaline into breathing room, stopping just one more impulses from hijacking discipline and derailing your trading plan. Define victory conditions beyond P&L. A disciplined no-trade day is a win. So is stopping after 2 losses or at max drawdown. You're not quitting, but preserving the player who can win tomorrow. When boredom tempts, use shadow trading, track hypothetical entries separately with no execution. Urges fade when they must meet checklist rules without dopamine reward. Train patience like a muscle. Run delayed entry drills after trigger prints. Demand 1 extra confirmation before acting. It feels slow, that's the point. Rotate silence windows. Avoid social feeds during active hours. Review afterward. End each day by grading 3 metrics: respected quota, obeyed cooldowns, avoided chasing. Hitting 2 is progress, 3 is excellence. Ritualized waiting builds alignment and durability. Trading gets easier once you stop treating outcomes as judgments on who you are. Your P&L is not a personality test, it's hypotheses colliding with noise. Build an identity firewall. I am not my last trade. Each trade is a business decision under uncertainty, executed with finite discipline. Sometimes you pay an invoice called a loss. That invoice is not a scandal, it's operating cost. Detachment begins with language. Replace "I was wrong" with "my thesis was invalidated at X because Y." This keeps focus on evidence and rules, not shame. Success is process compliance. Did I size correctly? Did I wait for the trigger? Did I respect invalidation instantly? A loss taken by plan is valid. A win earned by breaking rules is invalid. Training dangerous habits. Position size is clarity's lever. If your heart rate drives decisions, you're paying too much for access. Size small enough that your prefrontal cortex stays online while price moves. Calm is not luxury, it's where edge lives. You want curiosity, not desperation, observation, not defense. Proper sizing transforms stress into space for rational choices and consistent execution under pressure. Think in series, not events. Edge expresses across dozens of trades. 1 trade is noise, 5 misleading, 20 begin to speak. Detachment means letting the series speak before editing. When identity separates from result, you stop moving, stop chasing pride, and execute boring routines that compound. Losses become tuition receipts. Rules the boss, and the next trade gets clean attention. Detachment isn't summoned, it's scaffolded pre-session. Pre-commit vulnerable parts, max risk. Objective invalidation. Profit logic. and session limits. Write them down at your desk. When markets heat, you won't rise to occasion, you'll fall to preparation. Rules preloaded protect you from improvisation when emotions peak. Discipline isn't willpower, it's reducing choice under pressure by designing structure. Run sessions from if, then rules. If trigger prints at marked level with higher timeframe context and is greater than or equal to 1, 2 available, then enter with N risk. If price tags invalidation, exit immediately. No commentary. If first partial hits on R, move, stop to break even. These rules shift decisions from adrenaline to protocol, ensuring consistency. Protocol keeps execution repeatable and separates emotion from action. Install cooldowns to metabolize dopamine. After execution win or loss, start visible 5-10 minute timer. No orders during countdown. After 2 consecutive losses, end session. You're not quitting, you're preserving tomorrow's operator. Cooldowns build discipline by interrupting emotional spirals. Structured pauses convert adrenaline into reflection, safeguarding consistency and preventing impulsive escalation after stress. Constrain frequency and time. Cap eligible ideas per day. Define windows you never trade first 30 minutes. Lunch drift, or 5 minutes near tier 1 news. Boredom is not a reason for action. Guardrails reduce noise and keep process intact. Structure saves bandwidth for valid signals. This limits emotional wear and converts patience into a rule rather than a mood. Practice emotional hygiene. Before clicking, do 1 box breathing cycle 4 in, 4 hold, 4 out, 4 hold. Label your state with 3 words: tense, rushed, clear. Labels reduce effusion. You act alongside feelings, not from them. This ritual shrinks emotions' grip, keeps perspective, and restores clarity. Hygiene ensures actions are deliberate and not hijacked by impulses masked as urgency. Simplify the environment. Use a tight watch list and clean layout as edge. Multipliers, fewer flashing choices, fewer places for impulses. Architecture doesn't erase uncertainty. It removes self-negotiations. When plans are visible and binary, rational brain stays online. The trade becomes what it should be, a business action executed by rule, reviewed by evidence, forgotten in time for the next hypothesis. If you want feelings to stop steering the wheel, give it to numbers. Build KPIs that grade behavior, not outcome. Percentage of trades meeting checklist, percentage respecting size, percentage of exits executed as planned, and impulses declined. Post these metrics where visible. When they improve, P&L follows lagging but loyal. Numbers replace emotion with structure, guiding consistent discipline in trading. Journal like a lab notebook, not a memoir. Capture 1 screenshot. 5 checklist items. Entry, stop, target, size, and result in R, not dollars. Add 1 actionable insight to implement tomorrow. Patterns emerge: time of day effects, stress contexts, setups that underperform in low volatility. Journaling turns noise into evidence. Data drains drama and transforms mistakes into measurable learning points. Strategize protocols, not pep talks. After 2 consecutive losses, shrink size automatically e.g. 0% to 0. 5%. Extend cooldown. Switch to observe only until next A setup. You're protecting operator, not ego. After 3 green trades or hitting profit target, stop session. Euphoria tempts rule breaking disguised as genius. Protocols cap highs before they capsize you. Structure protects consistency, Track psychological drawdown beside equity. Assign each session a 1-10 stress score and a 3-word label type. Rushed. Reactive. If stress trends high, cut size until calm returns. Calm isn't luxury, it's part of edge. Monitoring psychology, like capital, ensures resilience. Emotional regulation becomes measurable, and stress feedback loops guide necessary adjustments. Protecting calm sustains the operator's effectiveness. Separate review from rumination. Fix a 20-minute post-market window to log trades. Update KPIs, and plan. When timer ends, market is over for you today. Detachment is a habit, not mood measure process. Follow streak protocols, and emotions will learn to sit in passenger seat. This ritual prevents endless replaying of mistakes and preserves clarity. Structure closes the mental trading day. Detachment is ritual, not willpower. Pre-market 1, write if, then rules. Mark 2 or 3 levels. 3, set alerts. Close irrelevant charts. Tape a note, no setup. No trade. Ritual creates a disciplined entry state. Preparation hardens boundaries before emotions rise. Detachment begins with visible structure that constrains action and removes improvisation during heated markets. In session. Run on rails. After each trade, hit a 5-10 minute cooldown timer. No orders. No tinkering. 1 box breath cycle. 1 state lo kam, tense boa. Keep quotas max 2 trades and time filters. Avoid first 30 minutes. Low liquidity lunch. Victory conditions clean no trade day. 2 loss stop. Or target, hit and close shop. These rules preserve tomorrow's operator. Add drills to train detachment. Delayed entry drill once weekly. Demand extra confirmation before acting. Shadow trading drill log hypothetical trades for 1 session. Graded by checklist. These exercises expose how much urge is dopamine, not edge. Practicing drills rewires habits, replacing compulsive impulses with structured patience. Detachment becomes trainable skill, not abstract concept. Control environment. Strip layout. Kill pop-ups. Mute social feeds during sessions. Keep 1 journal template open. Friction breeds exits. Fewer levers mean fewer emotional mistakes. Minimal workspace supports maximal focus. Clutter-free setup ensures clear headspace. Decisions stay anchored in predefined rules, reducing temptation to improvise under stress. Simplicity becomes an edge. Install hard emergency protocol. Break a red line rule, like widening a stop or doubling after loss. Immediately close platform, write 5-minute incident report, and reduce size next session. Mantra loss igual a cost. Rules égale boss. Next trade only. Emergency rituals catch spirals early and reset discipline. Protocol saves capital and confidence by interrupting destructive cascades. The fastest way to get trapped by the market is falling in love with your label. I'm a breakout trader. I'm a mean reversion guy. Labels feel tidy until regimes flip and they become cages. Think toolbox. Instead, you're not the hammer but the craftsperson, choosing among tools based on conditions. Strategies are instruments. Your job is tool selection and risk control. Keep the backbone constant, parameters flexible. Backbone checklist. Sizing, invalidation, journaling cadence. Parameters timeframe. Entry filter. Stop distance, partial taking logic. These flex with conditions. Adaptation doesn't mean reinventing yourself. It means swapping parts in the same sturdy frame. A stable core with flexible details preserves identity while staying aligned with market conditions. Structure provides durability and agility together. What signals a swap is needed? Look for regime shifts, not random losses. Expanding or contracting volatility, changing liquidity or spread behavior. Session structure shifts, or news density creating spikes. These are market-side triggers. On operator side, monitor self-regime sleep debt, stress, attention. A tired nervous system dulls any tool. Adapt to markets and yourself without rewriting core rules. Adopt a scientific stance, observe, hypothesize, test, adopt, roll back. Notice fake breakouts. Wider tails hypothesis require extra confirmation. Widen stops, trim targets, or use mean reversion tools in ranges. Test small, log results in R. Roll back fast if data doesn't support. Treat system evolution like experiments data-driven, reversible, with focus on expectancy. Avoid ego-driven overhauls. Most traders defend ego. Adaptive traders defend expectancy. When strategy is identity, you argue with tape. When strategy is tool, you upgrade it. Keep toolbox open, backbone intact. Allegiance sworn to results, not labels. Ego blinds, expectancy guides. Flexibility ensures survival and growth. Professionals detach identity from tactics, maintaining focus on outcomes and protecting capital through adaptability. You can't adapt if you can't detect. Watch volatility like a sailor reads wind. Expanding ATR, stretched candles. Wicked stops mean widen breathing room, temper size, demand confirmation. When ranges compress and price drifts, tighten risk, moderate targets, accept momentum scarcity. Volatility dictates adjustments. Align parameters with market energy. Recognize expansion versus contraction to avoid mismatched tools. Liquidity is sensor too. If spreads jump, slippage shows near opens or news. Depth thins adjust, when and where. Narrow instruments, confine execution to stable windows, favor limits over market orders. Structure completes read higher highs and lows with VWAP support. Invite breakouts, flat value with rejections, rewards, fades, or waiting for clean break. Retest. Don't misuse tools. News clusters create weather. Tier 1 releases bend behavior enough to invalidate edges. Buffer them or step back. Also monitor your regime sleep debt, stress, distraction, shrink edge to 0. A readiness score helps 10 sharp. 3 cooked. Map directly to risk standard size when strong. Half when middling. Flat when frayed. Operator condition is as critical as market state. Tie readings to traffic light habit. Green equals baseline parameters. Amber equals small tweaks, slightly wider stops, less size, extra confirmation. Red equals stand down. Journal. Adaptation isn't reacting to wiggles, but aligning tools with prevailing conditions. Volatility, liquidity, structure, calendar, and your own nervous system. Process stays constant. Parameters flex to preserve expectancy. Disciplina ensures resilience. Adaptation without a protocol is just tinkering with better branding. Treat each change like a scientific trial, define the hypothesis, alter only one variable, gather enough samples, and judge by data. Write it in your journal because, issue, I'll adjust one parameter for 20-30 trades. Success means higher expectancy with equal or lower stress. Adjust only one knob at a time. Shrink exposure while testing. Lower per trade risk from 1% to 0. Tighten loss gaps, and accept that the goal is information, not profit. Run baseline rules. A against experimental tweak B. Record in R, not dollars, so clarity isn't distorted. Add stress notes, 1, 10, and one-line reflections like calm or hesitant. A tweak that raises stress will collapse during real conditions. Even if it seems effective, set a review cadence and honor it fully. Mid-test edits are impatience disguised as discipline. When the sample closes, compare A versus B. Honestly check win rate, average win divided by loss, expectancy, variance, and stress. If B wins and feels smoother, adopt it, formally update the playbook. Stop calling it a test. If not, roll back calmly, record the reason, and move forward without unnecessary drama. That's structured adaptation. Most traders chase novelty, but adaptive operators collect evidence. The true edge isn't in clever ideas, it's in proving or disproving them with small, reversible bets. Intentional changes, measured results, and spreadsheet-based decisions separate the disciplined from the reckless. Evidence, not moods, should determine what survives. Change on purpose. Measure what matters. And let data, not feelings, decide whether a tweak deserves permanence. This is how lasting improvements are made. Adaptation fails when ego takes over. Keep a firewall between identity and tools. You're not a breakout trader, but an operator running the breakout tool when it works. This wording matters. It lets you retire tools without losing identity. Anchor consistency in 3 core rules: risk sizing, the 5-point checklist, and journaling. Flexibility happens around this frame. Upgrade slowly. 1 small tweak monthly, not a total reinvention every week. Install unbreakable redline rules. No strategy swaps during drawdowns. No stop widening. No doubling down to recover. If a rule breaks, end the session. Write a brief incident report and lower size next time. Watch for ego signals: urge to prove, hostility toward markets, or craving to recover status. When spotted, switch to observe-only mode. Ego pushes just one more, but process preserves tomorrow and keeps discipline intact. Define success through behavior, not flashy results. Track fewer rule violations than last month. Lower average stress and steadier expectancy. Review quarterly like a coach: which tools earned a spot, which need refinement, which should be cut. Speak like an engineer, not a hero. Keep the structure, tune paramètres, and measure again. Adaptation means staying the same disciplined operator while your tools evolve just enough to match changing environments effectively. Risk is the backbone. All else depends on it. Fix risk per trade at 1-2% of equity and convert it into dollars before checking charts. That figure is your insurance premium, small enough for clarity, steady enough for compounding. Pair it with a strict reward to risk threshold of at least 1-2 after costs. If potential returns don't double the risk, it's not a trade. Just hope disguised as opportunity. Protect yourself with kill switches. Stop trading for the day if total loss equals 3 times per trade risk, and for the week at 6 to 8 times. Consider stopping as winning the long game. Operate with if, then rules. If trigger prints with HTF alignment and is greater than or equal to 1, 2, available. Enter. If invalidation hits, exit. If 1 R tags, partial exit and move stop. Always enforce 15-minute cooldowns after trades. Journal like a scientist, not a storyteller. Keep records short and precise. Include 1 screenshot, 5 checklist items, context. Level, trigger, invalidation, exit, entry divided by stop, divided by target, divided by size, and outcome in R. Add 1 actionable insight like, next time, wait for VWAP retest. Track KPIs percentage following full checklist, size compliance, exits by plan, and declined impulses. Add stress. score 110, and scale down if emotional pressure consistently trends higher. Maintain media hygiene as rigorously as trade hygiene. Ban social feeds during active hours, only review charts and content post-market. Distractions create FOMO, distort perception, and push unnecessary trades. Risk management defines survivability, while structured journaling transforms experiences into repeatable edge. Done consistently, these practices allow both capital and psychology to become fertile ground. Protect the soil first. Scale only from stability. Before increasing size, demand at least 20-30 trades executed fully by process standards. Require KPIs near or above 80% checklist compliance. Disciplined sizing, planned exits with drawdowns contained within predefined limits. Average stress should remain 5 out of 10 or lower. If any measure slips, scaling is prohibited. Growing without this foundation invites unnecessary risk, fragile confidence, and potential setbacks that erase long-term compounding benefits. When stability is confirmed, scale incrementally. Raise per trade, risk by 25% only, for example, from 0% to 25% while holding all other parameters constant. Apply the change across a 20-trade sample. Measure results in expectancy R and psychological impact. If expectancy improves and stress stays stable, advance another step. If results weaken or stress rises, immediately roll back to the previous setting. Evidence, not feeling, must dictate adjustments. Treat pyramiding as optional, not standard. Add size only if the thesis remains intact after progress. Protect with ratcheting stops. And never exceed total per trade maximum risk. Use automatic descaling after 2 consecutive losses. Will drop to prior risk tier. After hitting kill switches or recording stress above 7, switch to observe only until an A setup appears. These rules keep risk stable, prevent ego-driven escalation, and safeguard long-term survivability. Run growth on cadence, not impulse. Review weekly to log stats, variance, and psychological load. Decide monthly to keep increase or decrease risk based strictly on numbers. A simple ladder 0% for 4 weeks, then 25% if KPIs remain strong. Repeating before further scaling. Evidence ensure growth. Excitement destroys it. Progress that preserves discipline compounds reliably. Only measured, rule-based scaling keeps expectancy durable across seasons and market changes. If there's one idea to take with you, it's this: the market rewards durability. Tiny edges, applied with discipline, become meaningful only when you protect them long enough to compound. That's why we built 4 pillars: a compounding mindset that treats $100 like a seed, ruthless patience that waits for A setups, emotional detachment that turns losses into operating costs, and relentless adaptation that swaps tools without sacrificing the backbone. Together, they form a quiet engine. Protect first, grow second, repeat. Here's your next move. Pick one upgrade for tomorrow. Maybe it's locking in a fixed risk per trade, printing the 5-point checklist, or adding a cooldown timer after every execution. Small improvements, repeated daily, beat grand overhauls that never stick. If this helped you steady your plan, subscribe and turn on notifications so you don't miss the next deep dive. I post playbooks, live breakdowns, and simple drills you can run in under 10 minutes. Drop a comment with one thing you're going to implement this week and the mindset shift that changed how you see your account. I read every one. Finally, share this with a trader who's talented but tired. The long game isn't glamorous, but but it's generous to those who show up with standards. See you in the next video, where we turn today's notes into tomorrow's execution.